Okay guys, going to start talking about working capital management today. This is the second dot point in your financial strategies. With the cash flow, we're going to be looking at that in class next week. So working capital is all about keeping your liquidity up so that you can meet payments as they fall due, or also take advantage of opportunities as they arise. So if we're looking at liquidity, of course we know that we're looking at the top of the balance sheet, and you've got your current assets and your current liabilities. And the most important thing that we're going to focus on is understanding that there is a relationship between these. Current assets include cash, inventory, and accounts receivables. At the same time, over on current liabilities, you have accounts payable, okay. You might have short-term loans. You may also have an overdraft, which operates exactly the same as you may also see it as credit card. Okay. The quality of current assets is almost important as the level of current assets. And as we know, we always like to work with a 2-to-1 ratio. That's in a perfect world for a normal business. There are some businesses which can operate with a lower ratio, okay, but most businesses like to operate with 2-to-1. But it's one thing to have a 2-to-1 ratio, it's also the quality. So you need to have, if you have a low capital management ratio, so if you're a petrol station, you're always going to have plenty of cash. So you might have something which looks like this. Which would give you a 2-to-1 ratio. Okay. And as you can see there, because this business has a high percentage of that in cash, it could probably operate at a low liquidity ratio. But for most purposes, we look at the best case scenario as being 2-to-1. Okay, so now we move on, and we need to understand first of all that there is a cycle. Okay, we have accounts payable, which is what we use to order stock. Okay, that comes in and becomes our inventory, which people then buy off us, and that becomes our accounts receivable. Remembering that everyone in the business world operates on credit. Once that accounts receivable is paid, it becomes cash, and we use that cash to pay our accounts payable. So if a business can't manage this cycle, and if cash becomes too low, we may not be able to meet those accounts payable. Okay. We may also have some other short-term debts which again we can't pay because we simply don't have enough cash. So the problem really seems to be with our cash management is that maybe we're not collecting our accounts receivables. Okay, we're not being efficient in how we collect them. Maybe our inventory levels are too high. Okay, if you have a lot of inventory there and it's not being sold, then that's cash which you otherwise don't have. So we're going to have a look at a few strategies, and probably the easiest way to look at it is to look at the current ratio. Okay, so if you remember that the current ratio is current assets over current liabilities, or as a ratio. So we have two sides of the balance sheet here to work on. We need to work on improving current assets and decreasing current liabilities. Okay, so if you're running on a 1-to-1 current ratio, you can work on either side, try and reduce those current liabilities or try and improve those current assets. And there's a number of different strategies which we can do to do this. Now, in your next lesson, you'll actually be given a sheet, a copy of this, so please don't write all this down, but we're going to go through a few strategies now. So let's look at the left-hand side of the sheet first. So here we're really looking at controlling current assets. I'm just going to reduce my screen a bit here. Okay, so we can see that our three main current assets are cash, receivables and inventories. How do we improve our cash? Well, every business should have a cash budget. So if you plan out, you can actually detect when you're going to have high amounts of cash within the month and when you're going to have low amounts of cash. Why would you do this? Well, you might want to look at how you pay your bills. For example, if your telephone bill is going to come at the beginning of the month and all of your other bills, you want to make sure that you have a high level of cash left at the beginning of that month. Alternatively, you can actually look at spreading those costs differently. So instead of having a once-off insurance hit, okay, of $2,000, you can get that insurance spread out over monthly payments. And most insurance companies will actually let you do this at no extra cost. Okay, or you could actually, instead of spreading them out evenly, if you're a ski hire business, make sure that all those costs that come are paid in those high revenue months. So you can actually spread those costs out. You can determine when they come. Not all costs, but most costs you can negotiate with your supplier or the person giving you the bill how and when those payments are made. Also, lots of businesses like to use leases. Now, leases are fantastic because not only do they prevent you the once-off cost, okay, so instead of going out and buying a steamroller, you would actually go out to a lease company and hire it or lease it, okay? And by leasing, you're spreading your cost because you're paying it on a monthly basis over the year. And you're also, if it's an operational lease, you don't have to pay for the maintenance and the upkeep and any basic management of that asset. All right. Now we'll do some extra strategies in class, but let's now go over to receivables. Receivables is what I think is the key for the current ratio management, liquidity management. If you're not offering discounts, if you're not penalising late payments with interest payments, then the chances are your payees are not going to be paying on time. And many businesses find this is the most troublesome part of financial management, is actually collecting money off customers, okay, collecting bad debts. So, as I've already mentioned, there's two ways you can do this. We can give discounts for early payment. You can also provide extended and ongoing credit for those customers who you value, who have a good payment history. Okay, and this actually becomes a marketing tool as well. We can also factor the debts at a discount to a factor company. Now, I've talked about this in class, but basically this is where you may have a debt of, say, $100,000. This is an accounts receivable. Okay, we're looking at the left-hand side of the balance sheet, and you're having trouble collecting that in. You only have $10,000 cash, and you want to try and improve your cash. You will actually sell this $100,000 of money which people owe you to a factoring company. And they might purchase it off you at a discount of 30%, so they might buy it for $70,000 in the hope that then And by the way, that money goes to you, so now your bank balance is up to $80,000. Okay, although it's cost you 30 grand, you no longer have to worry about collecting that 100,000. And the factoring company then goes off and tries to get that money off people. Sometimes through the legal system, sometimes by just harassing them in different ways, and they might actually end up collecting $80,000. Okay, so they would do this on a continual basis, but a factoring company, basically they purchase your accounts receivables. Why would you do this? Because it instantly turns it into cash. Remember, it's not just the amount of current assets you have, it's the quality. Okay, and if a lot of your current assets are tied up in accounts receivables, then that's cash you can't use. Okay, your ratio still looks good, but we need to improve it. Okay, some of the things here, one of the extra strategies I could have included, battling with technology here, is also penalising late. Okay, so looking at penalising late payment, so you could do that by charging extra interest rates. Okay, over the right-hand side, last thing we need to worry about is inventories. You really need to match the level of your inventory with your inventory turnover. What I mean by this is, if you're a business which sells a high amount of inventory every day on a monthly basis, then you would need to have a high level of stock. But if you've got a high level of stock out there and you're not turning that into sales on a regular basis, then that's just money clogging up your current assets but not turning into cash readily enough. So you need to reduce the level of inventories. So basically here, if we're looking at a management strategy, things like JIT are fantastic, because JIT reduces the level of inventory and all of the costs associated with that, like rent, labour and security, and frees up your cash. So if you're not spending much of your money on inventory because you're using JIT, that's more cash you have to pay those current liabilities. Also adjusting stock levels to seasonal demands. Okay, taking into account, of course, the fact if they're perishable, and the reliability and frequency of deliveries. Now, if I can scroll down a bit. This isn't probably the area of current assets that you want to lift in order to improve the current ratio. All right? You don't want to increase. Okay. You don't want to really increase accounts receivables, and you don't want to increase inventories. What you should be looking at doing for effective working capital management is converting these bad guys into cash. Okay? So if you keep inventories low, keep receivables low, but have your cash high, that's effective working capital management. All right? You just need to make sure that you have enough inventories to cover sales, and that you are not being too harsh on your payees, your debtors, that you drive away business. You still need to have some receivables or the opportunity for people to pay you on account, because otherwise they'll take their business elsewhere. But that's the asset side. How do we increase it? Well, we try and increase the cash component. All right, and we can bring in cash from other areas. For example, if I was going to buy a car, okay, to help my pizza delivery business, okay, instead of using cash of $40,000, if I leased it, it might cost me $1,000 a month, and that's a lot more cash in the bank for me. So leasing is probably the ideal way of increasing your cash. levels. Okay, let's look at the other side quickly, and let's take off some marks I've made here. Control of current liabilities. Again, it comes down to payables and short-term loans. So here we have accounts payables, okay, and what I'm trying to say here is that it's not, you don't always want to reduce these to zero, okay, and as I said before, accounts payables are an excellent source of short-term finance, and remember that the more you use accounts payables, the less you have to actually use cash. Yes, I know it has to be paid off eventually, but these are an excellent source of short-term finance, okay? And what you need to do is make the use of those interest-free credit periods. If someone's going to give you 30 days interest-free, then leave your money in a bank earning interest and pay it at the end of that period. If you can manage it well, it's actually a good source of finance. So good payables management involves paying them off as close to the end of the credit period as possible. Okay, but failure to do this could, of course, lead to a couple of things: loss of credit, which will hurt you when you go to make new loans, and your reputation. Okay, and this can affect you getting accounts payables in the future. So the main strategies, remember, we want to reduce our accounts payables, is to pay accounts as they fall due or just before, and to negotiate good credit terms. Now with short-term loans, again, they're a necessary evil, okay? And I've just made a point here that all businesses will need to borrow in order to expand or purchase, okay? And without clouding the issue here, we don't want to beef up short-term loans, because that will actually affect our debt-to-equity ratio. Okay, and as you all know, that shouldn't be below 100% or 1-to-1. Okay, so the main strategy here with our short-term loans, in order to keep them down, is renegotiation if they're too high. Okay, and then also look at the terms of the loan repayments amounts. Now overdraft, which is, again, like I said before, basically just like your credit card, is useful when cash is unavailable, but should only be used when necessary. Okay? Because it's such an expensive way of paying for goods, you need to eliminate any excess in the overdraft as soon as you have the money available, i.e. during high cash flow periods. So, within each of those assets and liabilities, you need to look inside to improve the quality of current assets. And with current liabilities, you need to keep them down as low as possible. But make sure when you answer a liquidity management question, that when you're talking about payables, that it's wrong to get it down to absolutely zero, but you certainly shouldn't have any more accounts payables which are due over the due date. So if you're getting interest free, use it. It's there to be used. Okay. The same as short-term debt, but that short-term debt should be renegotiated and have if you extend the time of the loan over a longer period, the repayments amounts actually become smaller. Okay. But here are some of the strategies to actually reduce or improve your liquidity. Okay? Now, the first one is don't use cash at all. Okay? Now, there are two types of lease, and we'll do this in more detail later on, but there's the operational, which is just basically like hiring a video, and it's a fixed cost, but you don't get anything at the end of it. Once the lease period's over, that asset goes back to the business. And the other one is the financial lease. Many people use financial leases to get a car. They will actually lease a car, and at the end of the 6 or 7 years, there will be some residual value which you pay out, and you can actually buy the car yourself at the end. But a financial lease is where you have control of the asset. But the benefit of both is that it doesn't give you a once-off hit in the cash, in the back pocket. Leasing allows you to spend less of your cash on assets and spread it out over a greater time period. There are other benefits which you don't really need to be that aware of, but there are tax benefits and maintenance benefits, because while you're leasing an asset, you don't have to pay for its maintenance. It's usually part of the lease contract. Factoring, as you remember, is the sale of accounts receivables to factoring agencies. Okay, and again, this is an immediate improvement in cash. So whilst leasing, okay, reduces cash flow out, so I guess it keeps cash high, factoring actually gives you a cash injection by selling your accounts receivables. Now, imagine this. You've got a liquidity problem. Okay, let's say it's 0.8 to 1 or 0.6 to 1. You've got all these assets currently sitting in your balance sheet in the non-current assets section, and you want to improve your current assets, which might be sitting at 10,000. Okay, you might actually have a liquidity ratio of 0.5 to 1. So you've got a real crisis here. What you can do is actually take the assets which you own, sell them, so sell your car, okay? This will give you an instant $80,000 hit of cash, but of course you still need to use that car, so what do? Well, you lease a car back. Okay, and that might reduce that 80,000 to 75,000. Okay, depending on the terms of the contract, and I think it's around 750,000. Okay, so selling and lease back, factoring, and leasing are the real keys to working capital management, and you need to remember those three. But you also, in order to get up to that band 6 level, need to talk about the quality of your accounts receivables. So, keeping cash high as possible, keeping receivables at a manageable level, and also making sure your inventories are high enough to meet demand, but not so high that they're just taking up space. Okay, and that's it. So I'll put this up on Facebook. You'll also